Welcome. My name is Sasha Moore, and we're here today at the Commercial Finance Insights Live panel event. In this session, we'll be leaning on the latest Equifax quarterly commercial insights report to talk through where we are now, where this sits cyclically, including calling out the big R, and a spoiler alert, it's not about recession necessarily, what this means for business, what this means for broker, and what's next. Our panel will also be giving us some top tips for harnessing the commercial lending landscape over the next quarter or so. This will be reviewed from the lens of an economist, a private lender, a non-bank lender, and a commercial finance specialist and broker. So on this note, let me firstly start by introducing to our esteemed panel. Please welcome Scott Mason from Equifax.
Morning.
Matthew Porch from Aquamore.
Morning, Sash. Good to see you.
Likewise. Christian McCausland from Shift.
Morning.
Morning. Melanie Davis from Fortress Vampire.
Good morning. Thank you for having me.
Great to see you. So for everyone who's joined us today, we encourage you to feed through any questions you have to the panel via the chat function, and we'll address this at the end of the session. And please also feel free to let us know if there's a specific panel member you'd like us to address that as well. So, Scott, let's kick off with you. Bear with me for 1 second while I share my screen so we can all be referring to the same slide. Okay. So the recent Equifax research has demonstrated a significant decline in commercial finance demand. Scott, can you please talk through your main insights into where that's at and what the key drivers for that has been?
Yeah, thank you, Sasha. Look, so for those of you who haven't seen this report before, we put out a quarterly insights deck and we actually look at credit demand, insolvencies, and we do a quarterly spotlight as well. So just for those of you who haven't seen these graphs before, I'll just give you a quick orientation. So on the left-hand side, what we do is we look, because of the nature of lending, it's quite seasonal and cyclical. What we always do is we compare quarter to the previous calendar quarter, the corresponding calendar quarter. So what that means is on the left, you can see that those quarters going back in time. And what we've seen is probably the lowest quarter compared to previous quarter reduction in inquiries for some time, so at minus 5.2%. If you look at what the drivers of those are, on the right-hand side, you can see the actual index. So they're indexed back to just before COVID, December 2019. And as I said earlier, you can see it's quite cyclical. But if you look at quarter compared to previous corresponding quarter, what we can see is some interesting trends. First of all, as I said, overall, it's minus 5.2%. But if we look at asset finance, it's positive 5.2%. And I think that's really interesting because even though, obviously, and we'll talk a bit later, things are tough and some businesses are finding it quite difficult, we've still seen in some sectors strong asset finance requirements. And that always interests me because that is a sign that there is growth, because that's capital investment effectively. Now, correspondingly, however, if you look at business loans, throughout COVID, business loans continued to be quite strong performers, but they have really come off over the last couple of quarters. So it's minus 8.8% on the previous corresponding quarter. And that's really interesting. And if you look at what's driving that, or which states are driving that, that's really coming off in our two largest states, Victoria and New South Wales. So where business loans continue to be relatively strong, people are currently, because of maybe interest rates or concerns over the future, that sort of inquiries have dropped off. And also people aren't looking to refinance, because if you're on a long-term loan, you're probably on better interest rates currently than actually looking to refinance, which has also got to do with that number. And trade credit is also off a bit. Now, trade credit is heavily influenced by things like global supply chains, also consumer spending, so it's a bit softer as well. But trade credit tends to be not as dramatically in terms of ups and downs as asset finance and business loans.
Well, thanks for that summary. Matt, I might throw to you. How have you noticed market sentiment, and do these figures correlate with the types of inquiries that have been coming into Aquamore?
Yeah, look, it's not surprising to see business loans decreasing by such a significant volume year on year. As Scott said, it was surprising to see that business loans or their inquiries were pretty strong during COVID. Again, I think COVID was a bit of an outlier in respect of how things operated. You know, the banks were giving away money for free almost, and there was all this false credit that was created for business cash flow and all the rest of it. And I think now that we're starting to get on an even keel again, interest rates are starting to, well, they have increased, and there's probably still another couple of bumps to go, and that's created a lot of uncertainty around what people are actually going to be paying for their borrowings. That is leaning on decisions like employing staff or investing in the business. But it's interesting that asset finance has actually went up because, as Scott quite rightly pointed out, it's an investment, it's a capital expenditure in your business. So people are still looking to sustain their businesses and keep going forward. But I guess that uncertainty around where interest rates are actually going to end up, standard market functions would indicate that in a time of rising interest rates, the RBA have got what they wanted. They want that credit to shrink. They want that balance sheet to come down a little bit. So that part seems to be working. But the whole point of this webinar was, R versus R. Is it a recession or is it recovery? And the fact that asset finance is still going up could indicate that it's the latter as opposed to recessionary pressures based on a lack of trade credit, for example.
Yeah, I think you raise a good point. And Scott, I will go back to you. One thing that I've sort of noticed in a lot of market commentary is the notion of a softer landing. So what are your viewpoints in terms of where the market is now, particularly in terms of overall those asset finance indicators and what that's suggesting?
Yeah, so I've even through, during COVID, we saw the rise of what was called the sort of zombie company, right? So you had a view that insolvencies were at record low levels because people weren't collecting debt. There were lots of government subsidies, etc. And we're well and truly through that. And even though things like insolvencies have increased and they're higher than what they were, they're not at the catastrophic levels that you would probably believe if you looked at some of the media reports. So obviously there are companies who are doing it tough. There are increased levels of insolvencies, etc. But the thing which I find interesting is that there are definitely some sectors that are continuing to, and businesses within sectors that are continuing to be successful. And as I said earlier, the asset finance wasn't just strong this quarter. If you look at the previous quarter, which is always asset finance's strongest quarter, it was up something like, I can't remember off the top of my head, it was something like 19% or something quite extraordinary. And that goes back to well back into pre-COVID days. So clearly there are businesses that are looking to grow and they are seeing opportunities and they're taking advantage of those opportunities. So even though I've always been a little bit more optimistic than many, I see this as, a cautious sign that things are not, in my personal view, maybe we're not in for such a strong, or we're not in for a recession, but probably a lot softer landing than what some may have thought, say, 6 months ago.
Yeah, indeed. Thank you. So, Christian, I might go to you. From Shift's perspective, how have you, what are your thoughts in terms of business sentiment, and what type of inquiries are you guys getting in terms of demand for finance at the moment?
I think the sentiment's probably echoes exactly what Matthew and Scott just said, which is really it's a cautious approach. There's businesses out there that are going really strongly and seeing good opportunities still. And I think there's businesses out there that are finding it a bit tougher. And I think what comes out for me when we look at the market, it can be as isolated as, economically WA sort of sit a little bit differently to the East Coast. So things that impact the East Coast don't necessarily impact the West Coast simultaneously. So there's pockets of opportunity within regions of the country. And I think what we ultimately see is that we continue to see growth and opportunity in transport, civil construction. Professional services has really been quite strong as well through this period. And I know it's a bit of a catch-all, professional services, but certainly we've seen really strong demand still across both asset finance and some of the cash flow components there. So I think overall the marketplace is still fairly robust, and certainly we're seeing significantly a good opportunity on the horizon.
Okay, good. And I know on that note, a lot of businesses are gearing up for that busy holiday season. Is that a trend that you've noticed this year to be consistent as others, or is it slower or faster at a faster pace?
I think what we're seeing, we've always seen October, November, and December be quite strong, and it's interesting. The prior quarter was pretty much mimics exactly Scott's data, and I think what we saw in October was a bounce back, and the start of November is really positive as well, and really bouncing as well, and it's bouncing across a mix of both asset finance and cash flow, which sort of says to me there's a lot of people preparing for that new year period and to start the year off really positively.
Okay, great. And I know, Matt, when we were talking offline, at Aquamore, it's definitely accelerated. So is that typical in terms of this type of year?
Yeah, absolutely. Exactly what Christian said. A lot of trading businesses are certainly ramping up to cover the sort of cash flow that they might need to help sustain increased trading periods over the holidays. There's quite a lot of trading businesses that really rely upon a bumper Christmas to get them through. So inquiries are certainly increasing in that respect. I was a little disappointed to see the RBA put the rates up on Melbourne Cup Day. We did see a drop off in inquiries around about June, July, even coming into August, but that really started to bounce back, and I'm hoping that that's not going to have a dampening effect on inquiry levels and business loan applications. But I guess time will tell.
Yeah, indeed. So Mel, I'll throw to you. What have your observations been over the last few months, and is there anything that you were or were not anticipating with this Equifax data?
Yeah, so for me, I'm not surprised at the asset finance being as strong as it is, because we actually saw during COVID the transport segment grow astronomically, and it's now become the new safe space for employment, basically. So lots of people actually changed over from, they might have been concreters, now they're actually driving trucks, because wheels will make Australia go round, as we keep getting told. That's why we have the shortages for things getting to market shelves, is when we actually don't have enough drivers and enough people in factories basically pushing this stuff out. So I'm not surprised by the asset finance piece. I've seen a massive increase myself with a lot of the businesses that I deal with, trading in and trading up in what they were doing. So they are going for newer, more high-end equipment, and really getting quite granular to what they want per job. So a lot of my clients, for example, actually have government contracts. They're in the development space. So they're doing a lot of work on projects for the next sort of 5 to 7 years. So definitely for me, the asset piece picked up. The business loans, unfortunately, I think it's going to keep trending down. Fortunate and unfortunate in the same respect that I think people are being more cautious, that they're not band-aiding now. They're not trying to sort of do these quick loans to get them through something when there really isn't something set on the other side. And I think that comes down to better education in the broker market that's actually helping drive that, to be honest. Is that no one's looking for a quick win when it could be detrimental to a client later. And look, trade credit, really no surprises there. But what I'm personally seeing a lot of is the inquiry did drop down as soon as and this is literally when Melbourne Cup, on Melbourne Cup Day, I think it will continue to trend down, because prior to that, I think people had accepted that the high interest rates were the new normal, and it takes a little bit of time for people to get their heads around that. And it took a couple of months to see it start to trend back up. And probably the last 2 months, I think for me personally, business had definitely increased, inquiries had increased, and the quality of what we were seeing was up again. Whereas prior to that, we were seeing sort of desperate loans, people that were sort of at the end. Unfortunately, I think that we're going to see those again now, sort of November and December. I hope I'm wrong, I really do. But you know, the 25 years that I've done this kind of tells me when those times get tough, the smart ones sort of hold back for a little bit, and sorry, shouldn't say smart ones, but people tend to hold back for a little bit and just see how it's going to pan out. And obviously, those who aren't really in a situation where they can hold start pushing for further credit that they may not really or shouldn't probably get.
No, definitely. And Christian, from your perspective, with the quality of inquiries and the type of inquiries, have you had a consistent experience with Melanie or slightly different?
I would say Melanie hit the nail on the head, to be totally honest. I think we've seen really very mixed profiles coming through. And I think the challenge is exactly as Mel alluded to, which is, you know, we are seeing businesses that are trying to essentially get through. And we are seeing a lot of businesses, however, that are actually taking opportunities to grow and finding ways to invest in their business in the current environment. And I think the asset piece plays really interestingly, because the last quarter still being up on the previous quarter last year, after you have that massive kick up in the June quarter with the expiry of the instant asset write-off, which really pulled a lot of transactions forward, I think it's still maintained fairly strongly through this period as well. So those businesses are really investing the CapEx, even though it's a bit softer. I think a lot of people are just, once again, they'll probably make those decisions in the new year rather than in this quarter around some of that asset finance. But I think we'll continue to see that mixed bag on the credit side.
Yeah, indeed. And Mel, I'll go back to you with this question and further to what Scott and Christian have mentioned in terms of there are pockets of businesses that are investing and are looking to grow. I know you've mentioned obviously the transport area, but are there any other sectors or niches, industries that you're noticing are being sort of more opportunistic and really flourishing at the moment?
Yeah, look, anything in the e-commerce space is doing really well. Again, I think we found, and we figured this out in COVID, when people don't go out, they still spend online. Well, a lot of people, and this is at, you know, at a home level, a lot of people aren't going out and spending so much in the restaurant segments and things like that. But instead they are actually online shopping. And look, from personal experience, a few of my clients that started off with sort of themselves and packing orders and things like that, you know, on a weekend, doing anything from, you know, sort of clothing lines, beauty as well. Beauty has definitely picked back up. That they're actually sort of doing more online. They're getting rid of the shops. They got rid of them in COVID. They're never going back to them. So I'm seeing those pick up. Look, obviously the development and construction space is an absolute concern at the moment. We're seeing it that, you know, sort of one major developer a week is going down. Considering that was 90% of my core business, it certainly is something I saw. In saying that, though, I'm going to say that I'm seeing such a strength from very well-established sort of balance sheet developers that are really taking opportunity to pick up great sites and really, really good trades under that, who otherwise, you know, may have lost out or don't have the capacity to increase. So I'm seeing a big divide more than anything. I'm seeing top operators being exactly that, and quite frankly just dominating the market, where some that just did not have the business planning in place or didn't have the margins there are falling by the wayside, and unfortunately they can't be helped. So yeah, no, I think obviously transport, the beauty part always kicks up at this time of year, though. We know it, ladies, we all go before Christmas and get our everything done. So we're always going to see that, but yeah, those e-commerce spaces most definitely.
Okay, thank you. So Matt, I will just segue over to you again. And I know that we did touch on this briefly in terms of why asset finance does give us an indicator of market strength. So can we just go into that in a little bit more detail in terms of just furthering Scott's perspective from your take, why asset finance is so important in terms of giving that feeling of market stability?
Yeah, look, I mean, Mel made a good point that trucks, for example, you've probably seen them when you're driving on the highway. It says "Trucks make Australia move" or something like that. It's some saying, and it's right. It's Australia's a country that's done very well at making stuff. Infrastructure is always what keeps Australia afloat during times of sort of turbulence as well. A concern for me would be an increase in petrol prices. They still keep going up, and that's what's hampering the inflation data. That's what's pushing inflation up is petrol prices. So a lot of these operators will be feeling the squeeze on that as well. That's a little bit of a concern, but your hands are pretty much tied when it comes to petrol prices. I mean, there's obviously geopolitical pressures with the Middle East and all this nonsense that's happening over there. That's obviously causing a lot of pressure on that sort of thing as well. But yeah, look, people investing in asset finance, people need assets to make their business work, and that capital expenditure does give us a sign of, it gives us green shoots of what's going to happen. It's probably more into shift in Christian space, the asset finance stuff, and how much people are actually spending on those assets and what those assets actually look like. So it's very interesting. I think infrastructure, as I said before, the spending on infrastructure will be very important. But the International Monetary Fund actually said something last week that Australia are going to have to curtail infrastructure spending if they want to get inflation under control, which I found very interesting for an international body to actually make a comment on Australian domestic affairs. You'll see in Victoria, they've got a large project there at the moment worth 1.25 billion. I think it's a railway loop line or something that they're building, and they're talking about shelving that. They've also shelved the Commonwealth Games as well. That's a big blow to infrastructure spending. So maybe these macroeconomic pressures that other market commentators are picking up on is starting to filter through into sort of domestic and local government decisions.
Yeah, indeed. Scott, do you have any further insights to that point?
Oh, no, not really. I think it's been pretty well covered, Sasha.
Okay, fantastic. Well, I might go a little more granular at the moment. So when we were having a chat previously, we did notice that there is quite a lot of state variance in terms of the demand. So Christian and or Mel, WA and SA have performed particularly well year on year compared to previous. Do you have any insights as to why those two states in particular are strong performers?
Yeah, look, I'll start this one off. Look, WA may as well not be attached to Australia as far as its economic climate. This is, God, I hope I don't upset anyone with this, but then again, it wouldn't be the first time. WA is very, very self-reliant and hence why they basically govern themselves in everything that they do. Between the mining alone over there, it literally could break itself off from Australia and just do its own thing, right? So we're always going to see big changes between WA, especially even their property cycle. So I'm going to take this out from being business related and bring it back to sort of home stuff, because I mean I've done this for a long time and everything does go in a circle, right? So we talk about business and on flow into families. Even the WA property cycle does not work anywhere near the same as what New South Wales, Queensland, Victoria does, right? South Australia is a little bit different again, but WA is literally its own economy. Nothing that it does, things that it does can impact on us, but what we do doesn't really impact on them, is my point of view. So they just run their own race. We may as well pop a bubble around them and they'll do their thing forevermore. South Australia, I mean, that actually surprises me a little bit, to be honest, from South Australia, because we tend to usually see that South Australia sort of drags anything behind what Victoria does. They sort of get that sort of flow on from Victoria usually. And please correct me if I'm wrong, Scott, if I'm just making things up here. But you're Mr. Stats, not me. So South Australia actually surprised me a little bit, and I'm trying to actually think, what have they done? What have they invested in their economy to see this growth outside of what we've done? So yeah, that one's got me a little bit beyond.
Okay,
Yeah.
interesting insights. And Christian, from your perspective?
I think much the same around Western Australia. Certainly, economically, they've sort of stand alone. And they've got obviously the mining sector, but they've also got a pretty strong and robust agricultural industry as well. So I think they've got this nice sort of mix over there, and they invest at times that other states aren't investing as well. So I think the needs that they have run a little differently in terms of timing from the eastern states, certainly. In South Australia, a little bit from my perspective, not too different to Mel there, but I think certainly there is some strength in, they've changed government over there, and I think there's also been a bit of investment across some different factors over there. And once again, economically, they've got some mining projects that are online, and certainly got some strong agriculture as well. So I think we're seeing probably just a flow-on effect of those factors.
Okay, indeed. Well, moving pace, let's move into the whole notion of business entries, exits, and insolvencies. So, Scott, let's start with business entries and exits. What's the state of play here at the moment?
Okay, so this looks at the 23 versus 22 in terms of net business growth. So what we've looked at is, or what we've gone through in our spotlight in this quarterly report is really the net change. So one of the things that we always spoke about during COVID, for example, was insolvency rates. And there's lots of focuses on insolvencies, but what there's not a focus on often is what I'd call voluntary entries and exits. So what you see here by industry, and this is ANZIC code, is you can see the net impact. So for example, if you took all of the businesses that entered, new businesses, startups, if you like, were started up versus the ones that exited. So these are people, for example, you might have the local fruit shop or coffee shop or whatever. They may not sell their business. They may not go insolvent, but they decide that enough is enough, and they exit. So what we've got here is a net by industry type. There's not surprisingly, if you look at some of the things like construction is slightly negative, but if you look at something like accommodation and food services, which always shows up highly in insolvency rates or retail trade, you can see that the actual growth has been negative over the last 12 months. So there's more businesses that are voluntarily exiting that market as opposed to those who are entering. Now, why this is interesting is if you actually look at it over the last 4 or 5 years, even during COVID, the net number of businesses the net number was always positive. So this is the first time in the last, say, 3 years where the overall number is almost even. It's a slightly positive, I think it's 0.5% business growth in terms of entities. And that's been the first time that it's been that low for a very long time. I mean, as I said, even during COVID, the net business was growing in terms of number of entities.
And what to you does that suggest that flat line means?
Well, to me, it means that if you've had 3 or 4 years of net business growth, and then all of a sudden it drops way down to almost flat, it means that people are either getting to the point where interest rates or other things are getting such that they just don't want to be in business anymore. And it's another, like insolvency rates, is just another early indicator or another indicator that things are a bit tough out there, and people are starting to evaluate their future and what they want to do in terms of staying in business or exiting.
Okay, and Matt, thrown to you, what have been your observations?
Yeah, look, there's no real surprises in that data there. I mean, healthcare and social assistance, that will continue to increase year on year. I think that's recession proof. Australia's got an ageing population. You've obviously got a very good healthcare system, and obviously, as I said, a rising, an ageing population. So that will always increase, in my opinion. I think a lot of the smart property developers and people like that will take advantage of that and start to invest in aged care and social housing and stuff like that to really take advantage of that market. And you've obviously got the heavy government subsidies in that area as well. So if people have got a lot of investment to make in there, then it's probably it's probably quite a smart move. Retail trade being down as well, not so much surprising. People are having to make decisions now about where they spend their money. Again, it goes back to standard market functions around the RBA increasing the cash rate to pull some of that money out of the economy, and retail trade will take the brunt of that as usual, which after the recovery from COVID, you do have to feel a bit sorry for some of these operators. And Scott made a very good point. It's not necessarily an insolvency problem. It's people have opened a coffee shop or a pizza shop or whatever you want to call it, and they're breaking even. They're not making money. It's it's costing them $10 to put a coffee out there, and they're making $10 just. So it's, what's the point? Go and work for someone else that's already there. And we're seeing quite a lot of that with even with certain finance brokers. They used to be self-employed, now they're working for someone else, or they've went back to the bank, and that's just a sign of where things are at the moment. Alcohol used to be recession proof, but that's starting to drop off. That tells you a story or two. The stats don't surprise me, but I think it'll be very interesting to see how it plays out from here.
Indeed. So staying on insolvencies, Scott, I'll throw back to you. Can you give us more insights about the state of play with insolvencies at the moment?
Okay, so I mean, if you look at this chart, you look at month-on-month changes, you can see insolvency levels at the top left-hand side, they're down 22% on the previous month, right? But if you look at that compared to 12 months ago, and as you can see their monthly charts, is insolvencies, as I said earlier, are up definitely compared to 12 months ago, but that's moderating. So, as I said, we're still seeing an increase in insolvencies year on year, and in some states such as New South Wales and right there, that's quite substantial. Same with South Australia, Queensland, but in other states, things are starting to moderate a bit. So yes, it's interesting because again, maybe as I said, this is my feeling is that insolvencies were low for a very long period of time during COVID. Last year they caught up and they surpassed levels earlier in this year. But the trend would suggest it's getting back down to sort of normal, a normal pattern and a normal level.
Okay, which actually leads us to our next discussion point, to call out the big R. So Mel, I particularly like your take on this, and rather than the discussion being around a recession, it being more about a recovery. So can you expand on what you're defining as a recovery, or where you're seeing the state of play?
Yeah, absolutely. Look, I've never benchmarked whether we're in a technical recession or not, quite frankly. It has to be about recovery, because quite frankly, what are we going to do? Sit in a corner and rock and wait for someone to come and give us a hand? Absolutely not. So I think we're going to see more and more amalgamations of other businesses. Matthew was just saying about it before, where you're actually seeing, even brokers go from being, one-man bands to joining together and consolidating, trying to get the best out of a really bad situation. I mean, I don't think any of us are going to pretend to say, oh, everything's great. I mean, I've literally seen people stealing food at Woolworths, people that wouldn't be doing that. So absolutely everybody is hurting in one way or another. I don't care what business you're in. Things that were bulletproof, alcohol is no longer bulletproof. Some of my best clients have got, 6 and 7 bottle shops. We're driving lovely Ferraris, are now using Afterpay and things like that in their shops to actually have, people still participate in something they otherwise would have. But look, it has to be about recovery. It has to be about really good type business planning, and it And this is for every business within Australia. So part of what I do, I actually do deal with businesses, not just in lending to them, but I actually do structure and planning. So I get to see this every single day, where they have to, unfortunately, some jobs have to go, fluff jobs can't be there anymore. They have to be very, very careful with the contracts they're taking on. Long-term relationships that have been had by some of my clients, for example, they've had to start cutting their payment terms down just to make things work so that people aren't outbridging getting, these business loans and things like that. No offense, obviously, we love business loans, we love them for growth, but not to try and cover up holes and deficits, right? So for me, focus is on recovery. Recession is already in. I don't care about the technical matrix. I'm not a politician. I get to say what I want to say. We're in recession. We've been in recession for bloody months. It's been tough, but it has to be the planning and the foresight to get through. We've had, I think some things that probably my generation and slightly younger than me didn't have to learn. So if you grew up in the 80s, I know Portia, you'll definitely are this one, but if you grew up in the 80s, 80s and 90s, your parents were paying 22% interest. They had 2 jobs. You were at the neighbour's house because mum and dad were both still at work, and there was sort of one person in the street that didn't work, because everybody else had to go out and get double-time jobs. They did what they had to do to push through what was apparently the worst recession in Australia. We've had the GFC. That was horrible. This is worse than the GFC. I hate to tell you, it really is. But it is about planning your way through it. It is about getting through dollar by dollar, still aim that little bit higher, but actually do things that are within your scope, right? Some people just need to, I think, sit back, and we have to do this in our own space as business people ourselves, and with our clients especially. We have to guide them, because people are just out there trying to get more loans to cover up worse situations and things like that. What happened to budgeting? Why doesn't anyone know how to budget anymore? Seriously, we need to go back to very, very basic things to push through. And the most successful businesses I'm seeing have already done that, and they started doing that 12 months ago, and they were doing that during COVID, and those practices stayed the same. Okay, so for me, we're in a recession. We've got to recover from it. If not, go have a cry in the corner and go pick up a job with someone else, right? For the rest of us, we're going to power through, and we're actually going to sustainably grow through it, because we're changing and adapting. My business has changed like you wouldn't believe from what I thought it was going to be 2 years ago, from, purely doing large scale construction, development. If I was just doing that, I would have died and starved by now.
Yeah, actually, Mel,
to diversify
you raise a really, really, really good point. And I think that COVID, I've always had the viewpoint that COVID's done not only the broking business, but business in general a favor, in the sense that we're now out of that set and forget model. And I think that businesses agnostically are far more aware of their bottom line, aware of their infrastructure, aware of where their fat is. And conversely, making more time to engage with professional service partners. So whether that be accountants, planners, and so on and so forth. So the opportunity that I see, as the panel has also talked about, is really putting that line of where businesses are set for growth and where they are recovering and where they are putting into plan measures to ride out this storm, but not looking at it from a reactive place. So I think that COVID has done us a favor from that perspective. Christian, I will throw to you in terms of what you're noticing from Shift's perspective, particularly in the recovery space and businesses purchasing patterns, and sort of where their mindset's at in terms of how they're purchasing and what type of purchases that they're committing to.
I'll use a different R word, and I'll say resilience. I think one thing that we've seen,
I like that one,
over a period of time now is, and I'll go back to the GFC and COVID, and a lot of businesses need to look internally before they look externally. And I think revenue is a really difficult one to control. You can only control so many mechanisms within your revenue, but you can certainly control a lot more of your costs. So I think that's one thing that you sort of see. And we have our SME Insights that's published on our website. And if you actually look at the tracking of our index around revenue, transport and professional services have actually been able to grow their revenue over the last 2 years. And they've actually held for the most part their cash balances as well. So they're actually growing their revenue without having a significant impact on cost. Whereas you can see other industries that haven't really been able to leverage up their revenue at the same rate their costs have hit them. So I think Matt's example of the coffee shop, as price of coffee goes up. At what point can I charge $10 a coffee before I don't actually sell a $10 coffee? So there's all these things that impact businesses. So I think the resilience piece is really critical to that. What we're seeing beyond that is this idea of deferral of particularly CapEx is really interesting, and you can defer equipment purchases if and hold where you are, but they have a tendency to hit you in a different way. It tends to be, instead of a increased payment, it ends up being increased cost around maintenance. So take your transport operator, your civil operator. The longer you stretch that asset out, it tends to cost you more at repairs and maintenance. So there's always there's always pros and cons with every decision, and I think that clarity of understanding the cost is really important to that. So we're still seeing, and we'll continue. I don't suspect we'll continue to see any less of it. Transport will continue to go fairly strong for the same reason that's been laid out, which is it's the only way outside of rail to get stuff around the country. So it's critical to everybody. I think civil construction is still an interesting marketplace. There's still that investment there, and the IMF might say what they want to say, but certainly at the moment there's a lot of committed spending that's underway and will retain. It's a lot of that contractual based revenue for those companies. So you're considering continually seeing that investment in those assets as well. And I think there's businesses that will continue to invest in premises and further development around assets that actually produce income value for them or save cost for them. So you've got to be in one of two of those buckets.
Okay, I do really love the third R in there. So Matt, I'll throw to you. Recession recovery, resilience. What's your perspective?
Yeah, resilience is a great word to certainly throw into the mix. We do see a lot of very resilient customers, and Australia as a country is very resilient, just in general. Very hard working spirit, and exactly what Mel was talking about, where when people need to make things happen, they do make things happen. And I think a very interesting case was when ASIC took on Westpac over the Shiraz and steak HEM calculations. I think Westpac won that case repeatedly because they said people can change their spending patterns if and when required, and you can't put everyone in the same bucket. That if times are hard, what are you going to do? You're going to go out and drink Shiraz and eat steak every night? The answer is no. You make things work the way that they have to, and say the very large majority of clients that we've got here are very well performed, and that resilience piece is exactly what drives us and keeps Australia ahead of the curve in that respect.
Yeah, indeed. And I guess also just on that note of looking ahead, just taking a look at the current Equifax data, as well as, year on year, what that suggests. Matt, staying with you, what indicators do you think that we have, both from a statistical perspective as well as just general market sentiment, about what to expect for 2024?
Yeah, I mean, Mel made a very good point that technically, according to the standard definition of what a recession is, Australia is not actually in recession, but yeah, I'm in agreement that we probably are, to be honest. I think statistically, yeah, we'll see an increase in business applications over the Christmas period to help sustain trading demand and all the rest of it. I think people's attitudes are changing from the whole band-aid approach where I've got a cash flow issue, I'm going to need to borrow some money to cover that up. It's more a long-term, this is a strategy and this is how we're going to get through it. And I think that ties in with all the data that we've seen, where businesses are consolidating, mergers and acquisitions are probably going up. I think M&A in the SME space is very hard to track and quantify because it's, two businessmen get together and merge their businesses. Who's recording that data, right? Obviously, corporate M&As are very easy to track because it's in the news and all the rest of it. But yeah, I think a lot of people, one-man bands, will start to get together and consolidate their business and make cuts and adjustments where they need to get things working. I think that will see us through probably the large part of it, and the rest of the fallout will end up in PAYG positions or part-time work to see them through until things start to stabilise. And look, I think picking out between the 3 R's: resilience, absolutely; recovery, 100%. And I think the recession won't be as bad as many in the media and many certain elements of market commentators will have you believe.
Okay, thank you. And Mel, over to you. In terms of, again, the same question, looking at the stats as well as market sentiment, what are you expecting for 2024?
Look, I'm expecting some good bounce back, to be honest. I'm expecting the beginning of the year to be quite slow, a little bit cautious, waiting for probably that next interest rate drop and, the silly season to be over. And then I think personally it's going to be growth. I think that the new normal has to set back in again. These are our rates, these are our situations, and it's time to push forward. So I think that some of the projects that may have been shelved by sort of, especially in the housing segment, will come back out because we do have a rental housing crisis. So, perhaps the government might start to push a little bit more resources that way to try and sustain some of these developments. But I think that we're going back for, and I'm not going to say growth. I think that we're just trying to get back to normal, to be honest. So I think it's time for that people will just basically get on with the job. I know it sounds terrible, but that's literally what's going to start to happen. I did start to see that happening already. And then, Melbourne Cup threw it out one more time that people got a little bit shy again. But again, I think the more that we talk about this as being something as normal now, and this is what rates should look like. I mean, does everyone know that the actual home loan interest rate, for example, on average has been, around 8% for, the average marker? It's something like that. And we saw them at 2%, and everyone went, yeah, that's what we're going to do. And then when they start to return to normality, which is actually what it is, everyone freaks out. It does make things tougher. But the fact is, we've got no choice. So just get on with it. That's what I'm expecting. I'm expecting everybody to actually act like big grown people and decide to get the F on with it.
And I think that resilience piece is key. And I think, Matt, to your point as well, I think we are culturally very resilient. I think we've learnt to be more resilient and more forward planning off the back of COVID. And similarly to what Scott was saying, historically and cyclically, we're as expected. So Scott, particularly on that note, and I know that obviously Equifax doesn't forward plan, but is there any indicators that you've noticed sort of so far that seem atypical moving into the next quarter for next year?
Oh, no, only the ones that the two things which are atypical, the ones that I discussed at the beginning. So it'd be interesting to see if asset finance demand continues to be higher than expected. And it'll also be interesting to see what happens with business loans. Like Mel, I'm expecting the business loans to maybe not keep falling, but certainly to be lower than expected. And a lot of that, as I said earlier, is around a lot of our inquiries traditionally come from refinancing, where that's not going to happen because if people are on a good deal, they're not going to be shopping around. And also people are, I think it's probably a little bit more cautious at the moment. But yeah, I think the one that I'm keen to keep an eye on is what happens with asset finance if that continues to be strong.
No, indeed. And Christian, to put you in the hot seat for 2024, what are your insights based on market as well as the stats that have been presented?
Look, I think I sort of have the same view as Scott. I think the interesting part for me is I suspect that February will have a bit clearer insight as to what's actually going to happen. I think, we will see some continuity of positivity in the market, and I think there'll be further opportunity. I'm really interested to see after the second quarter this year how asset finance performs in that second quarter next year. But certainly I would suggest that there's going to be a lot of assets that are going to be available, and there'll be some strong businesses that will take those up. In terms of the cash flow, look, I think people will find opportunities. They always do. And as long as I think you stick to that same principle I sort of mentioned around, you're either borrowing to build revenue or you're borrowing to impact your costs positively, then I think you can stick to those premises and you'll continue to grow and develop your business.
No, I agree. And I know, Matt, we were also talking offline that Aquamore in particular, there's been quite a lot of demand for bulk purchases coming up into this busy holiday period. Do you echo Christian's sentiment?
Yeah, look, the experienced operators, they certainly know what they're doing. They've got a real tight understanding of their cash flow, which is obviously key to running any business, and they get themselves prepared, they get it done early, and we're seeing a bit of that where they'll buy in bulk for this trading period. They also take advantage of economies of scale. Obviously, the more you buy, the cheaper it is. But as I said, it's the experienced operators that have been around for 20, 25 years that they really know how to plan for that, and they don't mind making that investment in their business to get that done. Regardless of what interest rates are doing, they know that they need that stock and they need that liquidity to help them get to that point. So yeah, as I said, the experienced operators, they're the ones that we are seeing coming through now asking for X, Y, and Z. So yeah, we're seeing quite a bit of that.
Okay. Well, before we wrap, I do want to pick all of your brains about what your top tips are for harnessing commercial lending over the next quarter or so. So Mel, I'm going to throw to you for that.
Okay. So for me, and I'm actually going to talk from a broker's point of view, how to maximize whatever opportunities are there, is actually do a proper review on your existing clients, your existing database. Don't bother going out to get new people. Go and actually tackle what you have and get the referrals from there. The more you know about your client, the greater their experience is, and to be honest, the greater the opportunities are for you. My business actually relies on word of mouth more than anything. You really don't see me advertise or anything like that, and I haven't had to for a long time, because I actually know my clients. I know every single part of their business. I know when they're going to need cash flow injections and when they're going to be okay, and how we're going to ride those out and even them out. So I'm actually integrated into majority of my clients' businesses. In fact, one of my office here is actually in one of my clients' businesses, because I know the day-to-day operations. Now, not everybody can do that, and I understand that, but for me to actually get my hands on as a broker, as a third party, the person who's actually in control with these clients and getting them to the right lending is imperative. Okay, so please don't just go for whoever's got the greatest, the quickest turnaround. We really have to think very, very carefully on behalf of our clients. It is our responsibility to ensure that we're putting them in the right products, not quick, short cash. And I know that sounds funny because I specialize in private lending, but I'm seeing massive problems in that area where unfortunately people haven't known what options are available and they're putting people into the wrong products. And we're kind of trying to undo that stuff. I'm just going to say be very, very diligent with your clients, because without them, you don't actually make any money as brokers. It's very simple. So please integrate yourself into those businesses, full plan what they need before they tell you as well. So that's it for me.
And I think you raise a really interesting point, particularly at this time of year, that a lot of businesses do use the January period as that period of reflection. So to me, there'd be a great opportunity, not probably before the Christmas rush, but post-Christmas, to really proactively instigate that health check. Yeah. Yep. So Christian, what about you? What would your tips be?
I'd echo Mel's sentiment, to be honest. I think as a funder, I think it's important that the brokers become closer to their customer. I think serving value into your customer is more than just waiting for the phone to ring. I think being proactive back out to the customer And to Mel's point, understanding what's in market that can actually support your customer in need. But equally, if you're reactive to that situation, it creates problems down the track for the customer. So being in front of it and understanding what their needs are moving forward is critical to that. And we see that. We see where brokers are really close to their customers, really understand their customers, and the outcomes are much better than the broker that's waiting for the phone to ring, and then the phone rings and there's a problem and I'm trying to resolve the problem, which becomes tougher, much tougher for the broker and also their customer at the end of the day. So I think if I take anything away, that's what I would really focus on, just getting really close near to your customer.
Yeah. And I think, that it's the proactive versus reactive play. And I think particularly if times are a bit more turbulent, a bit more challenging, that proactive play is key. One thing I do want to touch on that Mel did raise, which I agree, Mel, there is a challenge in industry, particularly in the private lending space, is that transparency. So perhaps, Matt, could you just provide maybe if the brokers a few insights, like what are the types of questions to be asking a private lender to make sure that you're fully understanding what it is that you're committing to or suggesting to your customer?
Yeah, 100%. I mean, during volatile interest rates, you do see a lot of baiting. You do see a lot of new names pop up with these tracking headline interest rates, and we get a lot of that saying, "Oh, look, can you do better than this price?" And everything seems to boil down to that price point, which in this space, I think you need to understand your client's requirements. You need to understand who it is that you're dealing with. You need to understand where that money is going to come from. There are a lot of very good operators in the private lending space, reliable, institutionally backed lenders, for example. And if you've got a relationship with these lenders and you understand that they're not going to let you down, then use them as best you can. But there's a lot of, as I said, there's a lot of these cracking interest rates that are coming up with lenders you've never heard of, and you don't know whose money it is, you don't know what the terms are. And we get a lot of clients that say, look, it's we've been offered this and been offered that, but they've been waiting 5 weeks for a letter of offer. And it's what's your client's time worth, especially in this busy trading period, especially for a 12-18 month term facility. It's not a 30-year loan that you're putting your client into.
And the fee grabbing too, Porchy. Sorry to interrupt, but the fee grabbing, that here's a term sheet. Give me $10,000 for this, $2 million loan or something like that as a commitment fee, or call it whatever you want, with no guarantee to proceed. If the rate looks too good and you've got no form and you can't check who it is that someone is dealing with, so you can't call 1 out of 10 of your close circle of broker friends and actually ask them who that person is, or have you transacted with them, then don't do it. Don't do it, because as brokers, we end up being the ones that wear the brunt of a client who's possibly paid for something and got no service in return. It is us who unfortunately get to manage them through, and ultimately it was us who actually directed them to it. So it's your reputation above all else. The client in the end doesn't care who actually received the money. They care that you led them to a rabbit hole of nothing. Sorry to interrupt you, Matthew, there, but I get really passionate on that because I unfortunately have to help a lot of people out with it every day, from being led to the promised land wasn't really there.
No, it's really good that you mention it, because you took the words out of my mouth, to be honest. I see it firsthand as well, and you get these promises about stretched LVRs and we're going to do it at this and we're going to do it at that, and 2-3 weeks goes by and the LVR drops 15 points and everyone's in a bit of a mess, and
your rate went up 10.
That's it, yeah. And look, as a lender who sometimes sees these second-hand transactions, it can be hard to rescue that with the broker, because everyone's frustrated. There's a valuation already paid for. There's all of this poor sentiment floating around the transaction, and a lot of the time it becomes too hard and it puts people under too much pressure, and you end up having to pass on good transactions because of what's happened previously. So just be very careful about who you select, and just make sure that your relationships with your lenders are strong and you understand what they do, and that makes everyone's job a bit easier.
Indeed. Well, thank you all so much for your time. I could definitely talk about this for far longer, but I am conscious that the time is ticking on. So, Scott, let me start with you. Thank you so much to you and to Equifax for sharing your insights and going into the report in such detail. It's been extremely helpful. Thank you, Christian, for your insights in all facets of commercial lending and the state of play. To Matt for your commentary about the general market, global influences and private net lending. And Mel, thank you for your on-the-ground insights, for keeping it real, and for your tips to industry. So on that note, have a great rest of your day, everyone. Thank you for tuning in.
Thank you so much.
Thank you.